Section 1. The Fed just moved. Here's what it means for your money. The Federal Reserve just tweaked the dials on the American economy. They cut interest rates. This might sound like distant news, a headline meant only for Wall Street traders and economists in dusty offices. But this single decision, made by a small committee in Washington, D.C., sends ripples that will eventually reach your kitchen table. It's a move that can change the cost of your car loan, the interest you earn on your savings, the price of the house you dream of buying one day. It can make the stock market jumpy or calm it down. So why should you care? You should care because the Fed's actions are a quiet but powerful force shaping your financial life. This small change, a cut of just 0.25 percentage point, is the Fed's way of saying something has shifted. For months, their main enemy was inflation, the relentless force that made your groceries more expensive, and gas. They fought it by making money more expensive to borrow, hoping to cool things down. Now, they see a new worry on the horizon, a weakening job market. This rate cut is their first significant step to address that new concern. It is a pivot, fighting yesterday's inflation battle to preventing tomorrow's employment problem. Understanding this pivot is the key to understanding what might come next for your money. Section 2. The quarter-point cut, what just happened and why? On September 17, 2025, the Federal Open Market Committee, or FOMC, made its move. This group, led by Fed Chair Jerome Powell, voted to lower its main policy tool, the federal funds rate, by 0.25 percentage point. This brings the new target range to between 4% and 4.25%. This was not a surprise. Most experts, market watchers expected this exact decision. It was a small, cautious step. It was not the kind of dramatic, large cut you see in a full-blown crisis. Instead, it was a finely tuned adjustment, a signal that the Fed is changing its priorities as the economic data changes. The main reason for this decision, as Powell explained in his press conference, is the shifting balance of risks. For the past few years, the biggest risk was inflation running too high. Now, the Fed sees a growing risk of the job market weakening too much. Powell pointed to recent numbers showing that job creation has slowed down significantly. He mentioned that the economy was adding only about 29,000 jobs per month over the last 3 months, a pace he believes is below what's needed to keep unemployment from rising. Section 3. Winners and losers. Your wallet and your debt. When the Federal Reserve cuts interest rates, the effects are not felt equally by everyone. There are clear winners and clear losers. The most immediate winners are people with debt, especially variable rate debt. If you have a credit card balance, a home equity line of credit, or an adjustable rate mortgage, this rate cut is good news. The interest rates on these products are often directly tied to the Fed's benchmark rate. It might take a month or two to show up on your statement, but you should see the cost of carrying that debt go down, leaving a little more money in your pocket each month. Borrowers looking to take out new loans also stand to benefit. The cost of getting a new auto loan, a personal loan, or even a small business loan may tick down. On the other side of the coin are the savers. For years, as the Fed raised rates, savers were finally rewarded with higher yields on their savings accounts, money market funds, and certificates of deposit. These high-yield savings accounts became a safe and attractive place to park cash. A rate cut signals the beginning of the end for that trend. Banks will likely start lowering the rates they offer on these savings products. If you have money sitting in a high-yield account, you might notice the interest you earn begins to shrink. The era of earning over 5% on your safe cash may be drawing to a close. This creates a dilemma for people who rely on interest income, particularly retirees. The stock market's relationship with Federal Reserve rate cuts is complicated. On the surface, lower interest rates are usually seen as a good thing for stocks. When rates fall, borrowing becomes cheaper for companies, which can boost their profits. Lower rates also make boring, safe investments like government bonds less attractive. If a bond is paying less interest, an investor might decide to take a bit more risk and buy stocks instead, hoping for a better return. This increased demand can push stock prices higher. This is the textbook theory, and it often holds true over the long run. However, the market's immediate reaction can be much more messy and unpredictable. On the day of the announcement, the market was mixed. Some parts, like the Russell 2000 index of smaller companies, rallied. These smaller firms often rely more on borrowed money, so a rate cut is a direct benefit to their bottom line. But other parts of the market, like the tech-heavy Nasdaq, were down. This happens because investors are not just reacting to the cut itself, they are trying to figure out why the Fed is cutting. If the Fed is cutting because it sees serious economic trouble ahead that can spook investors and lead to a sell-off. The key is that markets are forward-looking. They are constantly trying to price in what will happen 6 to 12 months from now. The housing market is arguably the part of the economy most sensitive to the Federal Reserve's actions. When the Fed aggressively raised rates to fight inflation, the housing market went into a deep freeze. Mortgage rates soared, pushing the dream of homeownership out of reach for many families, locking existing homeowners into their low-rate mortgages. This rate cut, and the signal of more to come, offers the first real glimmer of hope for a thaw. While the Fed does not set mortgage rates directly, its policy rate heavily influences them. As expected, mortgage rates had already started to drift lower in anticipation of this move. For potential home buyers, this is a significant development. A lower mortgage rate can translate into a lower monthly payment, which directly improves affordability. For example, a half-point drop in the mortgage rate on a $400,000 loan can save a borrower well over $100 every month. That can be the difference between being able to qualify for a loan or not. As rates continue to fall, more buyers who were previously sidelined by high costs will be able to re-enter the market. This should lead to an increase in buyer demand, especially as we head into the new year. For homeowners, lower rates open up the possibility of refinancing. The Federal Reserve's decision to cut rates is a delicate balancing act, and it is not without risks. The primary risk is that they are moving too soon. Inflation, while lower, is not yet back to the 2% target. If the Fed eases policy too quickly, it could reignite price pressures. Imagine pouring gasoline on a fire you thought was mostly out. If consumer spending and economic activity pick up too fast, it could send inflation climbing again. This would put the Fed in a very difficult position, potentially forcing them to reverse course and raise rates again, which would be disruptive for the economy and markets. On the other hand, there is the risk that they are not moving fast enough. The labor market data has softened considerably and quickly. As Powell himself noted, the economy is in a low hiring, low firing environment. If this trend continues and layoffs begin to pick up, unemployment could rise very quickly because there are not many companies actively hiring. Moving forward, there are two key data points that everyone, the Fed investors, average citizens, should be watching closely. The first is the monthly jobs report. We need to see if the recent slowdown in hiring continues, stabilizes, or reverses. Pay close attention to the number of jobs created, the unemployment rate, and wage growth. Any signs of a sharp deterioration in the job market would put immense pressure on the Fed to cut rates more aggressively. The second critical data point is the inflation reports like the Consumer Price Index and the Personal Consumption Expenditures Price Index. The interplay between these two forces, the cooling labor market and stubborn inflation, will dictate the Fed's every move in the coming months. In the face of economic uncertainty, the best strategy is often to focus on what you can control. The Fed's rate cut and the endless speculation about their next move can feel overwhelming, but your personal financial strategy should be grounded in simple, timeless principles. The first step is to review your debts. If you have high-interest credit card debt, this is a moment of opportunity. While the Fed's cut is small, it signals a trend. Transfer your balance to a card with a lower introductory rate. Consider a personal loan to consolidate your debt at a fixed rate. Every dollar not spent on interest is a dollar you can save or invest. Next, take a look at your savings. With savings rates likely to fall, shop around. Online banks often offer better rates. Traditional banks may lag. If you won't need cash for a year or more, consider a certificate of deposit. For long-term investments, like your retirement accounts, stay the course. Don't make rash moves based on one day of market volatility. The core reason for the rate cut is to sustain economic growth, which is a long-term positive for the value of the companies you own. If you are in the market for a house, this is a time to be prepared. Mortgage rates are likely to be volatile but are trending in a favorable direction. Get your financial documents in order. Get pre-approved for a loan. This will allow you to act quickly when you find the right property. Watch mortgage rate offerings closely and be ready to lock in a rate if you see a dip. For sellers, the prospect of more buyers entering the market is good news, but it's still essential to price your home realistically based on recent comparable sales in your neighborhood. Finally, stay informed but not obsessed. Keep an eye on the big economic headlines, particularly the monthly reports on jobs and inflation, as they will be the primary drivers of the Fed's future decisions. A solid financial plan, built on a foundation of budgeting, consistent saving, and prudent investing, is designed to withstand this kind of turbulence. Control what you can, and don't panic about the rest.